Good morning. Welcome to our second objective function webinar, the latest in the series, and from the Washington, D.C. metropolitan area. I'm Russ Wormers, the director of the Center for Financial Policy at the University of Maryland's Smith School of Business. And I'm very pleased to have three learned and experienced panelists joining me today, whom I will introduce shortly. But first, I wanted to just talk a bit about the Center for Financial Policy that I direct at the Smith School. It is a major academic think tank, and our goal with the Center for Financial Policy, the CFP, is to interface with policymakers, financial regulators, and professionals in the financial industry, as well as academics outside of the Smith School. We have a wonderful website filled with resources, and I would invite you to Google Center for Financial Policy. You will find our link at as the very first link that Google suggests. This particular event, along with many others in the past, including an interview with Robert Litterman about climate change risks about a year ago, are located on the second objective function tab. So invite you to visit there after today's session, and today's session will ultimately be available there recorded. Okay, so today's session is on quantifying the financial impacts of climate change. As you can see, this is a white paper written by the three panelists that I mentioned, and they will describe how they have some unique modeling within this, in their discussion and within this white paper, and how that improved modeling can help financial intermediaries, institutions such as insurance companies, banks, investment management companies, to understand and quantify their risks to climate change in a much more robust model. Let me start here with Robert Brammer. Robert has a PhD in mathematics from the University of Maryland. He's a good Terp. He is an adjunct research professor in the Department of Finance and the Department of Atmospheric and Oceanic Science. We call that AOSC at the University of Maryland. Additionally, he's a fellow of the American Meteorological Society and is the chair of the Clean Tech and Climate Change Committee of the American Bar Association. Bob, can you please give us an opening statement for our group here?
Yes, thank you, Russ. Just by way of introduction, we have a few key points that we want to cover. So let's see. I hope you can all see my screen.
Yes.
So our purpose today is to describe a new method for quantifying the financial impacts of climate change. And in particular, we'll be talking about emphasizing this methodology as it's applied to asset and risk management. And there are three major points that I think distinguish this discussion from others that you might see in this area. We're going to be talking about why a simulation-based approach is preferable in this context to the scenario-based approach that many of the institutions are using. Secondly, our models incorporate what are called climate tipping points, and I'll say more about those in a minute, but those are very significant in terms of potentially increasing the climate risks uh, over the next decade much more quickly than previous models might have suggested. And then finally, we will talk about the notion of a climate damage function, and in particular, sector-specific climate damage functions that integrate both physical and transition climate risks into the modeling. And we will, in particular, focus on potential climate impacts and risk management over the next 5 to 10 year period, which is of primary interest to the major financial services organizations. And with that, I'll turn the floor over to Professor Rossi to talk about the perspective from the banks and other financial institutions.
Thank you, Bob. I'll introduce Cliff Rossi first. Cliff has been a professor of the practice and executive in residence at the business school at the Smith School of Business since 2009, after nearly a quarter century in the banking industry, where he held a number of C-level executive risk management positions at some of the largest financial services companies, including Citigroup. He started as a regulator for the thrift industry during the thrift crisis and has worked at both Fannie Mae and Freddie Mac during his industry career. Let me also add that Cliff is a terrific teacher and mentor to our students at Smith. He has a big fan base of former students, some of which work at Fannie and Freddie and other organizations that have benefited from his mentorship and teaching. Cliff, can you help us unpack a little bit here? A lot of stuff said by Bob. Can you help us unpack a little bit in some of the things that you might want to talk about, just for those in the audience who might not be as up to date on these types of thinking about these types of risks? One thing that's important about this paper is the interaction between physical and transition risks. And I sort of thought I understood what those are before I read the paper. I think I understand them better now, but I think the audience would benefit from a better explanation from yourself. What are physical risks and what are transition risks? And I know transition risks can take many forms.
Yeah, thanks, Russ, and for that, and we will certainly dive into that. Let me start off and a little bit actually ahead of that, and in the context of providing some insights helpful to understanding why we adopted a simulation-based approach at all to modeling climate impacts on portfolio risk that Matt's going to walk us through here in a little bit. I'd like to actually talk first about these so-called integrated assessment models and their use in generating climate scenario analysis, as well as to comment on some of the differences between bank financial stress tests and climate proposed and actually existing climate stress tests, I should say, that we see going on abroad. So first on the IAM side, now, many people, most people might not actually know what these things are. These are models that have been around for decades. They represent the way climate outcomes or outputs are really linked to socioeconomic outcomes. And for those of you who are in this space, probably very well familiar with the Nordhaus DICE model, for example, but there are a number of variants to these models these days. So if you think about an IAM, an objective of an IAM is something like to maximize discounted population weighted utility per capita of consumption. So in economic jargon, that is. And an important feature of these models, if you really dive into them, are their damage functions. And again, Matt's going to go through this in a little bit more detail, which translate things like temperature increases as a percentage of output, usually in some kind of nonlinear fashion. And so organizations like the NGFS have been using IAMs for quite a while in generating their climate scenarios. I think their model's called GCAM, for example. And to think about the strengths and the limitations of these things, on the strengths side, we're really talking about the ability to link complex, dynamic, physical and socioeconomic systems together. They take on an equilibrium modeling approach that really kind of helps us align conventional economic analysis that allows for demand and supply to adjust prices. They're comprehensive in their global approach to modeling climate effects. And they also provide these intertemporal outcomes over a long period of time, much further out, as we'll see when we talk about the financial stress test that banks and insurance companies conduct today. But on the limitation side, and this is a big issue, is that these models do pose a significant degree of model complexity and structural interactions that really make it difficult to understand model errors. And any of you who are in banking, particularly at a regulated commercial bank, for example, or insurance company, will come to understand the importance of model governance. And so trying to understand where those model errors come from is hugely important. When we think about these IAMs, for example, NGFS can produce estimates. Some of the IAMs that are used by the NGFS, that is, can produce estimates of the social cost of carbon or carbon pricing. And if you haven't had a chance to look at this in more detail, these estimates can really vary wildly over time, depending on things like the assumed discount rate that's used in calculating present value. So not surprising that, different administrations, will put a different price tag on the cost of carbon, and they usually get at that by changes in discount rates. Trump administration had a price of, I think, $8 per ton. The Biden administration has something that's a bit over $60 a ton, I believe, which is correct, right? Those kind of issues. There's a significant amount of uncertainty with these model outcomes, such as things like GDP losses, land use, and emissions. And there have been many economists, Pindyke in particular, that have famously called out IAMs as having little value, not my words, theirs, for evaluating alternative climate change policy. So there are some issues with these models. And we'll come back to that point in just a second. But before I do, let me talk to climate scenario analysis. When we think about financial versus climate stress tests, there are a lot of differences between the type of financial stress tests such as CCAR or DFAST that large banks conduct today and climate scenario analysis such as the Bank of England's recent Climate Biennial Exploratory Stress Test, or CBES. The big differences are things around time horizon. If you think about CCAR, we're going out 9 quarters. If we're thinking about CBES, we're going out 30 years. Linkages between these climate outputs and macroeconomic outcomes really comes down to data and models. And this is a big issue of where we really don't have this locked down very well. Time horizon is a big issue, creates an enormous amount of uncertainty around a single path. And it's for this reason, at least in my opinion, why a single path analysis in this case is just not optimal. And a simulation-based approach is better. I don't see how a bank or an insurance company could actually make any intermediate or long-term strategic or hard money decisions based on a singular climate scenario today. And I'll go back to my own time as a CRO. If I were forced to sign a sub-attestation, as I once had to do for loan loss reserves, I would not be able to do that on these climate stress tests as they're designed today. I just simply wouldn't be able to do that. Scenario analysis really works well when there are well-established empirical relationships between risk factors and outcomes like credit loss, home price changes, and default, for example, on mortgages, and loss severity. The stress tests in CCAR, for example, were designed in the aftermath of the 2008 crisis. I kind of know because I was on the front end of that when I was at Citigroup, when we were first the guinea pig to test out the old SCAP stress test. So there was quite a lot of information on the trajectory of those variables following a financial event like the 2008 crisis. Now, these effects of macroeconomic outcomes under a climate scenario, again, are not well understood, and that's why this single path can't inform regulators or banks with any degree of reliability on how climate change will affect financial outcomes such as valuation or loss. So if we go down to what, Rush, you were talking about earlier about looking at physical versus transition, the physical types of climate change effects are a bit more easy to get our arms around because we're really looking at those direct outcomes that affect, let's say, property damage, the impact directly on the portfolio from some type of hazard event. The transition risk, that is those relating to changes in some, let's say, greenhouse gas emission projection and its associated impacts on population dynamics, on GDP and other things, and how they then translate themselves into financial outcomes, really is a very tricky business. Now, another thing that's come about is with things like carbon accounting financial standards for scope 3 financed emissions. That's a very hard thing for banks and other companies to try to get their arms around as well as we're thinking about this. So what can we do? So from a methodology standpoint, we're not going to, we shouldn't abandon, right? We're not going to be able to abandon scenario-based analysis, but we should augment it with other techniques. In my time, again, we relied on a range of different methodologies, not just single stress pass or scenarios, but also things that looked at the distribution, the tail risk outcomes. That's what we commonly do in risk management if we're looking at measuring value at risk on the market risk associated with the portfolio, or operational risk even, or even credit risk. So we should try to kind of bake that into our analysis of climate change as well. And as Matt's going to discuss in just a little bit, we can conduct a wide range of sensitivity analysis on key parameters in our models. So from a tractability standpoint, it might be possible to leverage and adapt closed form solutions like we see in some of the risk-based capital, the Basel risk-based capital analysis, like so-called Vasicek default models, and generating a distribution without having to go through the laborious mechanical process of generating a Monte Carlo simulation. But nonetheless, there are ways to do this. And we're going to show you one of these that we've come up with. So let me leave it there for now and turn it back to you, Russ.
Terrific, Cliff. Let me ask you a quick follow-up here. So I think you're saying the integrated assessment models suffer from assuming an equilibrium over time. They assume kind of I guess optimal reactions by government and individuals and companies, where the world doesn't work like that. The world has tipping points, and I think that's we're going to hear a lot about tipping points in this webinar. And the other problem, of course, is that the IAMs are deterministic. You chart out what you think might happen under a particular scenario, and you just project that out 30 years. Is that am I interpreting you correctly?
Yes, I think overall that's the gist of this, and on a more specific basis, when you look at the damage functions that are embedded into these IAMs too, I think, and I'm not disparaging any of the work, there's been a ton of good work that's been done on this, but I do think that the relative simplicity of these damage functions that you're going to see in a moment, which we rely on significantly to generate these outcomes, there's a lot more wood that needs to be chopped on those, I believe. Yeah,
and just to return to my emphasis on transition risk versus physical risks, it's something as seemingly innocuous as consumers start preferring to drive purely electric vehicles or plug-in vehicles, or they start using public transportation. This could be a shock to the automotive industry, the petroleum industry, and others. Let me turn to Bob Bremer again, who will talk a bit about the value of using Monte Carlo versus deterministic scenarios in the model.
Simulation-based approach versus a scenario-based approach. When we're talking about simulation here, we're talking about it in the context of a Monte Carlo simulation. And just to summarize, the figure on the right talks about models that are based on past observations that create probability distributions from which samples are taken, and then generates many future scenarios. Now, most scenario-based approaches have maybe 3 to 5 different discrete scenarios, deterministic scenarios. Monte Carlo simulation generally would have thousands of these scenarios so that you could estimate probabilities of various events. So the advantages of a Monte Carlo simulation approach is that it allows you to incorporate uncertainty explicitly into the model. And then you can calculate the probabilities of various events, or parameters like value at risk, which I'm sure is familiar to many of you in the banking and investment industries. You can also model correlations of various inputs and do sensitivity analyses, because you may not be particularly familiar or particularly comfortable with some of the parameter choices you have to make. So you may want to vary those a little bit to see how the outputs that you calculate depend on the sensitivity to various parameters. Now, the disadvantages, of course, are you need to develop these probability distributions. And there are a number of techniques for doing that, but generally they rely on calculations based on data, and the incorporation of expert judgment that can give you some insight into likely future probabilities. So that's the first key point I want you to come away with, is the advantages of a simulation-based approach. And later we'll show you some specific examples of that. Next, I want to talk about extreme weather events and climate tipping points. And first, extreme weather, I took this definition from climate.gov, which is a US Weather Service website. We see these all the time and in increasing number and severity. And generally what the definition would be this would be an event which ranks above some threshold value, maybe in the top 5% or so of the events. For instance, in Dallas in August, in an 18-hour period, some parts of the Dallas area got up to 15 inches of rain, with periods of rainfall rates of 2 to 4 inches per hour, caused severe damage, flooding, even a few deaths. On the other hand, in California last month, I experienced some of this personally. I was in the Sacramento area that week when temperatures were well into the hundreds. In fact, the day I landed in California, Sacramento hit 116 degrees. So not only were these setting temperature records, they were breaking the temperature records by 10 or 12 degrees. It's an extreme heat wave. And overall in the US, we had more than 300 all-time temperature records set across the country. So that's one class of event that causes financial impacts in many ways. But the second class of events is called a tipping point. And this is a definition taken from the IPCC. This is the Intergovernmental Panel on Climate Change, a UN organization. And this is a level of change in a system beyond which the system actually reorganizes, does something qualitatively different all of a sudden. And for the climate system, it refers to a critical threshold when global or regional climate changes from one state to another. Now, this is not a theoretical possibility. There are many of these that have occurred in history. First example is about 450,000 years ago, the sea level rose significantly and overflowed the land bridge connecting England to continental Europe and formed the English Channel, which not only changed the climate, had a number of geopolitically significant impacts. And in fact, this is sometimes referred to as the first Brexit, when the UK left Europe. Now, with respect to climate change, rising temperatures generally increase the probabilities of these tipping point thresholds being exceeded, because there's more energy in the atmosphere that can raise these thresholds. Now, the English Channel formation is not unique, and there have been others more recent. The Black Sea, up until a few thousand years ago, was entirely inland, but rising sea levels caused a breach, and it flows through the Straits of Bosphorus, now connected to the Mediterranean. And this had a number of climate effects. It also created economic impacts and made Sevastopol a commercial and military seaport, which is, of course, integral now in the current Ukraine-Russian war. Another example was the termination of the African humid period when what is now the Sahara Desert, up until about 5,000 years ago, was much wetter, and it had agricultural products coming out of that. Another example, this was about a little over 3,000 years ago, when there were multiple civilizations in the Mideast. These were the Egyptians, Babylonians, Minoans, Mycenaeans, Hittites, et cetera, a very complex, interconnected economy with sophisticated supply chains and technology to build a number of complex structures and so forth. And suddenly, within a period of a decade, that all collapsed. And what happened was that the climate change, precipitation dried up, and the agriculture failed, and the famine caused starvation. Supply chains were destroyed and so forth. And it was hundreds of years before those areas recovered. So these are not theoretical possibilities. These are these can occur and have occurred in very significant ways. Now, over here in the lower right, there's a map from a paper that appeared in Nature a couple of years ago, showing various types of tipping points that we're currently concerned about. And these are connected. So one tipping point being exceeded can cause other tipping points to be exceeded. So for instance, in Russia, the warming is causing permafrost regions to thaw. That warming and release of methane and other gases causes melting of the Arctic sea ice, which leads to melting of the Greenland ice sheet. And together, those two are causing the Atlantic circulation to change, which has impacts on the Amazon. And we're also seeing melting in West and East Antarctica, which is raising sea levels. And there is the possibility of major chunks of Antarctica actually falling into the ocean. Now, there are a lot of uncertainties associated with that, and scientists are currently in research vessels down there collecting data so that we understand it. But the connectivity of these events and the potential severity of these events tells us that it's important to model those, and the current scenario-based approaches do not really incorporate these into their models. And the third point I want to talk about, Cliff mentioned the damage functions in the IAMs, and these integrated assessment models combine climate models with socioeconomic models. And starting with the work by Nordhaus back in the early 90s, for which he was later awarded a Nobel Prize, the climate models parameters, notably temperature changes, can be incorporated into a function which modifies the economic output from these socioeconomic models. So you have climate parameters feeding into the economic models, and we won't have time to get into it today, but there's the other notion of an abatement function, which is really the resources you spend to try to mitigate the effect of climate change. And so there is this feedback loop. We'll be focused on damage functions today. Now, a simple form of that, this is the form that Nordhaus introduced originally in his DICE model, and other people have used this form. It's still the most common form with different choices of the parameters A and B. So as time goes by, the temperature anomaly increases, and the damage function is related by this quadratic form. And the reciprocal of that quadratic form is the damage function. So it's less than 1, and it multiplies the output, for instance, the GDP. So the GDP is reduced by these increasing temperatures. Now, that's probably the simplest form of a damage function. There are other forms of damage functions being considered in the research community now, and some of them have parameters values that are much higher than the quadratic power, because one of the criticisms of the Nordhaus model is that it just doesn't cause enough damage. And the scientists feel that, and there is this controversy between the scientists and the economists over the level of damage potential from climate change. So that's what we'll be discussing here a little bit in more detail. So with that, Russ, I think I'll stop and turn the floor back over to you.
Thanks, Bob. So I think I understand that tipping points are important, and tipping points are difficult to forecast when they might happen. And I also appreciate that scenario analysis, as Cliff described, is important for understanding path-dependent outcomes that are either unlikely to happen or we can't think of very clearly today. It may be that heavy rainfall in regions of the world, or bad news may at some point, or high gasoline prices might at some point result in a vastly increased consumer preference for electric vehicles, or conservation methods for their housing and things of this nature. In other words, tipping points can happen unexpectedly. They can happen in clusters. They can happen sporadically. I think this is part of what the flexible modeling that this paper talks about is after. But let me turn to Dr. Matthew Lightwood. Matt, I apologize that we took so long to get to you. Matt works for Conning Risk Solutions and is responsible for quantitative modeling and providing technical expertise in economic modeling to support both prospective and new clients using the GEMS economic scenario generator. You may want to tell us a little bit about what that is. Prior to joining Conning in 2010, he worked as a senior risk consultant, where he was responsible for financial modeling, managing, and implementing large professional services projects for financial institutions. More recently, he's led projects to develop systems that enable users of Conning's software and risk models to implement climate stress tests for regulatory reporting purposes. Matt is a graduate of University of Manchester and University College London, where he earned a degree in physics and astrophysics, and he has a PhD in high energy particle physics. Welcome, Matt, and I'd like to invite you to talk in more detail about the model.
Thanks very much, Russ. Yeah, unlike Cliff, I haven't got a fan club, but hopefully I have some interesting things to say today, and maybe that changes. Yeah, maybe I can explain a little bit more about sort of what I do. So most of my work is involved in stochastic modeling of financial markets. So our main area of research is building an economic scenario generator, which is effectively a simulated global economy that includes things like interest rates and inflation, equity markets, municipal bonds, pretty much every financial instrument or vanilla financial instrument that you might think of, and simulating those into the future. Much more recently, I've sort of on the whole question of how we take those stochastic models and think about ways of applying stochastic techniques to the question of climate risk, particularly within the insurance and pension sector. Robert gave a sort of pretty good overview of physical risk and damage functions, and Cliff talked a little bit about physical and transition risk. I guess I'd like to add a little bit of mathematical formalism to both of those topics, physical and transition risk. And just to reiterate a little bit of what Robert said, starting with physical risk. Physical risks are usually assessed using a financial damage function. Much of the work for that, as Robert said, was, or at least the groundwork was done by William Nordhaus, Nobel Prize winning economist. I think someone very helpfully on the Q&A section pointed out that he maybe won that the Nobel Prize actually for his work on growth theory and not on climate theory. However, he's spent a lot of, I guess, the last 20 or 30 years or longer working on climate economics in large part, and continues to do so, continues to publish in this area. And the damage function that he proposed within the DICE model relates the damage to output or GDP with changes in global temperature delta T. And one form of it, I think this is the one that he used in the DICE R13 model, is shown here. And as Robert correctly said, it's effectively a quadratic relationship. However, there have been many different proposals for the parameters alpha 1 and alpha 2 since Nordhaus's original prescription. Some of the common ones are shown here in this table above. On the right-hand side, Howard and Sterner and Calcul and Vents, which is a more severe damage function. They're two different parameterizations of this model, and we'll sort of talk about this table a little bit more also later on. And the outputs of these models are also shown graphically as a function of delta T, temperature rise, in the plot at the bottom. Robert also mentioned there have been other proposals for structures of what this damage function might look like. One of the more commonly applied ones is the Weizmann damage function, which is shown here at the bottom. Has a few more parameters, adds a bit more convexity to the relationship with delta T, as we can see from the dotted blue line, which is the Weizmann damage function as a function of delta T. For transition risk, we haven't really talked about how that's usually quantified. And we usually quantify the impact of transition risk through the use of a marginal abatement curve. And very simply, the marginal abatement curve relates the cost of carbon on the y-axis to the emissions control rate, or ECR, on the x-axis. And the ECR is defined as the proportion of carbon that a rational agent might abate given a particular level of the carbon price. So the marginal abatement curve implicitly kind of assumes that there's an equilibrium relationship that balances what it costs to abate carbon through, for instance, investment in green energy technologies and the tax that you'd have to pay for not abating that carbon. So by defining sort of a future scenario for how we think governments might act on the cost of carbon and the carbon price, how that might evolve in the future, it's possible then to compute the impact of the scenario as a fraction of GDP, effectively the cost of that abatement, and then further assess the likely impact of that on the wider economy. And that's done very simply by integrating under the curve to the given level of carbon price. So in this example shown in the plot, we have a marginal abatement curve, blue line, and we might assume that the carbon price rises from today's level. We've kind of quoted a couple of numbers, Trump's $8 and Biden's 70 or 80 or $60, I think Cliff said. I think sort of consensus is somewhere in the middle of Trump and Biden. I'm not sure which politician that is. I wish I had better knowledge of US politics, but around about $30 per ton of carbon. But in this example, we imagine it increasing to a value of about $300, which would imply a rational agent would abate about 60% of their carbon emissions based on this marginal abatement curve. And we can calculate the cost of that by simply integrating under the curve to that value, which is this blue shaded area, with the remainder darker shaded area here being the tax that we would have to pay in order to abate that carbon. Because we haven't abated that carbon. But as both Cliff and Robert have said, there's kind of some major limitations with these approaches when we think about them in terms of practical application to the type of risk management I'm sure many of you are involved in. And if we go back to the first slide, there's a very obvious one here. The really big differences between the parameter values that are being suggested, but there are also really big differences between the model outcomes that we see here. So there's a lot of uncertainty around actually quantifying what the impacts of these things, of these scenarios might be. These models are also typically have very low impact at shorter time horizons. So if we think about current global warming at say 1.1 degrees Celsius, we see most of these models don't have a very large impact of physical risk at those levels. So when we think about that in terms of financial institutions trying to create scenarios on these things, that converts to very, very small shocks on asset valuations that many might consider kind of irrelevant on the timescale of normal risk management. And that's because these damage functions are really kind of mean or median outcome scenarios. So they don't consider shorter term risks like tipping points. And linked with that, and again, Robert touched on this, is the fact there's no distribution of outcomes being produced by these damage functions. So we can't really differentiate between the average and a worst case scenario. And finally, there's no real interaction between transition and physical risk. So they're treated almost in completely separate domains, as is illustrated in this schematic diagram here. And in our view, that's almost certainly wrong and not how the transition will play out, or actually even how it's playing out already. To date, what we see experientially is that it's large physical impacts that lead ultimately to transition policy changes. And there are a couple of really good recent examples of that we might consider. One is the 2021 floods in Germany that led to the rise of the Green Party. So if we look after that flood in Germany, we saw the Green Party increase, almost double its share of the vote in the national election, in the general election. And rolling forward to this year, we had an election in North Rhine-Westphalia, which was the Bundesland most affected by the floods. They actually almost tripled their share of the vote in the local election, going from about 6% to 18%, nearly 1 in 5 people voting Green in that election. Australia is another great example. The recent election, what many call the climate election, where independents with the colour teal, so teal being kind of blue with a good mix of green thrown in, swept the ruling Liberal government from power. And finally, the public kind of rejected what was decades-long deny and delay kind of policy to climate. And that was after wildfires that amounted to damages sort of in excess of 5 or 6% of annual GDP for Australia, as well as flooding. So it's really what we're seeing is it's physical events that lead to governments actually making a difference and creating policy changes. So when we start to think about that, we start to think about this whole narrative, and could we propose a unified physical and transition damage function, but also incorporate a discontinuous jump process for modelling of tipping points. And how this looks is we take the standard damage function that we saw earlier, which is this first equation, and we make the second parameter alpha2 a random variable, alpha2t, which is shown in this second equation. And what's more, we add the transition risk into the damage function, and we'll talk about how towards the end of this slide. And the form of this random parameter alpha2t that we used is shown in this third formula here. Effectively, our first pass at this was a white noise process around a central assumption with a Poisson jump process of random size. So the size is kind of randomized. And we should try and remember about why we did this. Why are we doing this? Well, we remember that one of the problems with the traditional damage functions is how much uncertainty exists in the parameter estimates. And when we have kind of a lot of uncertainty around a central assumption, And that's typically where stochastic tools and stochastic techniques are a really good tool to model it. Some might say even the right tool. Moving to this transition term, phi trans t. We compute this. So there was also a question, someone asking if we assume an equilibrium relationship in terms of sort of optimal policy response. So kind of. So in order to calculate this, this term, we do compute it still from a marginal abatement curve, but in a very particular way. So we assume that rather than governments increasing the cost of carbon by their own volition, which is kind of the optimal policy response, so you kind of, a lot of the IAMs probably assume that there's that rational players will act optimally, but mostly governments are going to act to try and get elected. So rather than assuming that they'll increase the cost of carbon by their own volition, embedded within our narrative is within our model is the narrative that actually the cost of carbon will only increase when voters demand it, and that will actually be driven by the size of physical damages experienced due to things like acute weather events. But how that looks mathematically is shown by this fourth equation for the cost of carbon, CT. You know, what we do is we simulate the physical damage, which is just this damage function. And if that physical damage, so we simulate lots of different paths, and if on a particular path, the physical damage exceeds some threshold tau, then the cost of carbon gets increased by some value that is proportional to the physical damage that has been experienced. The smaller damages, which first line of the right-hand side of this equation, where the threshold isn't breached, then the cost of carbon just stays the same within our simulation model. So effectively, governments don't do anything until they have to. And in this way, we create some feedback between transition and physical risks. And we can visualize how this looks by seeing some of the output of the model. And here we consider a scenario 15 years long, this dotted black line, where temperatures increase to about 1.6 degrees, it's by 1.6 degrees Celsius. And then we can see that the model produces an average scenario, the orange line, just like a normal damage function. But the inclusion of a stochastic element and tipping points means that we're able to produce much more severe impacts as well, at lower probabilities and shorter horizons. And that's the blue line, which shows the 1 in 20 year scenario, and the black line, which is the 1 in 100 year scenario implied by our model. So that means the model can be used to define a whole range of possible scenarios for a single temperature increase scenario, rather than just looking at a single average deterministic path that is then used as the scenario. And then these effects can further be cascaded down into the real economy and into the financial market and to specific asset classes, or even specific stocks through the use of defining a beta for those particular stocks. So I'd run over a touch, Russ, to apologise.
No worries, Matt. There's a lot of stuff going on here. I want to turn quickly to Cliff with a series of questions that maybe Cliff can field all at once. Cliff, let's turn to banking. What do you think will be the most challenging aspect for banks developing their climate risk assessments? Will they be able to leverage their existing stress models, data, and systems in preparing, or what will need to change? And also, what do you think is the most limiting aspect of climate and IAM models used to generate climate scenarios?
A lot of good questions there. I'd say addressing what I refer to as the square peg and the round hole syndrome, namely figuring out what the empirical linkages are between climate outputs and financial and risk attributes, in a reliable, and I emphasize reliable way, I think is kind of like the holy grail for banks and insurance companies to kind of get their arms around. We're not there, we're not even close to there, I think, but that's got to be where we head if we're going to do this well. The other question, will these companies be able, banks, for example, be able to leverage existing stress test models? Yeah, to a certain degree, I believe so. But there are some fundamental differences, like I pointed out earlier, such as time horizon and the relationship, again, between those outputs and financial risks that are going to be really challenging for some time to do. And then the last thing I think you spoke of was limiting aspect of these IAMs. And again, I'm not disparaging the important work and great work that's been done on that. Having said that, these models, these IAMs, produce a lot of uncertainty. And, you know, for those of us that are economists, if you will, it's kind of like one of those little secrets out there that few policymakers or industry professionals really have a great appreciation for. I think we just kind of go down the path of saying, hey, we've got these sophisticated looking models, they're generating these scenarios, and we're just going to implement them. I don't know what that does for us, honestly. Again, I was in the industry for many years, and I just walk away shaking my head going, I'm not sure that a single scenario is the best plan of attack here when we don't have a high level of confidence in the outputs from these models. I know that may be an issue, but that's kind of where I stand on that.
Thank you.
Well, Russ, let me just add a couple of things to what Cliff has said. The current scenario, say from the NGFS, they generally consider a few scenarios. One would be a business as usual scenario where there's very little done to mitigate the risk of climate change and you just let things go. Then there's another one that says strong action is taken early, and that would be more consistent with what the IPCC has proposed, that we take action to limit the increase in temperature to 1.5 degrees centigrade above pre-industrial levels. And the third scenario would be we don't act early, but things get so bad that we act late. And this is usually called a disorderly scenario, which would have a lot of chaos in the markets because there'd be sudden changes in policies, transition risks would suddenly appear. And so those three scenarios, but they're all deterministic. And the models are kind of like wind-up toys. You know, you put in the inputs and you let them go and they do what they do. The scenario or the simulation-based approach that we're advocating here allows those probability or those inputs not to be deterministic, but to be probability distributions. And then you can see what the probability distribution is on the outputs and calculate probabilities of various levels being exceeded, like a value at risk or something like that. So, I mean, this method isn't perfect either, but it's a significant advance over what is currently the state of the art.
That's right. And you've also within this model got sort of interpretable parameters. So within a scenario, you could adjust something like the voter tolerance threshold in order to say, well, we could assume over time that the voting public becomes less tolerant of climate-related physical events, and then you have a whole narrative around that rather than kind of a priori or upfront having to define what you think governments are going to do, which I just don't think there's any evidence for this viewpoint that governments are going to suddenly just decide that they're going to do a sudden transition and an early transition and increase the cost of petrol to everyone. You see what's happened during the Ukraine war. People are very intolerant of high energy prices, and they're going to need major incentives to vote for political parties that are pushing that idea. The other thing I like about this approach is that it is, I've heard a lot of talk of narratives out there being very important, but to me, a lot of that sounds like a talking shop. What we're kind of proposing is that you can add mathematical formalism to a particular narrative. So we could extend this model quite easily to include things like adaptation within the narrative. So we could include things like, well, our narrative is now that there's tipping points that lead to political change, that leads to transition risk. But after that tipping point, there's major investment within adaptation, that then over a longer period of time means that the impacts on GDP dissipate. So you
let me interrupt you there, Matt, because I found this fascinating. This is definitely a very flexible model, one that can be modified as you learn over time. Does the learning and the feedback that you're talking about in changing the model based on what has happened, is that entirely from human input to the model, human judgment?
Well, there's certainly, so the model has certain parameters. So one of the difficulties with all models is like, how do you estimate the parameters? And that's certainly true of this model. There's certainly a good amount of expert judgment that's needed. But, that's more than just guessing. So I could kind of pick on, a couple of maybe the important parameters in the model, or maybe I just pick on one given the time, which is like the jump probability. So how often should a tipping point occur? So within our model, that jump probability also depends on the temperature. So as the temperature increases, the probability of a tipping point also increases within the model. We've calibrated that based on the IPCC judgment that the probability of a tipping point is, I think, likely over 4 degrees. And we took likely to mean one in 5 years. I think they said high over 2 degrees. So we kind of calibrated to a judgment about what those mean in terms of probabilities. Looking at some of the more recent research, I'd say maybe we've probably lowballed those a bit, and we should have more severe jump probabilities. There's some more recent research that says we're on the cusp of tipping points already.
Yeah, let me just add a little bit to what Matt said. The whole history of this since Nordhaus published his original work in the early 90s is that our understanding of climate risks says they keep increasing. And so what we're doing going forward with our research will be to analyze some of these more severe damage functions, looking at trying to understand what is called catastrophic modeling in this context, because as any risk manager, and Cliff is a professional one, he wants to know what the worst case is. And how do you get your arms around this? Well, you aren't going to do that with modeling rather mild scenarios like, well, let's assume we can keep the temperatures down to 1.5 degrees. Well, what if it goes up to 4 or 5 degrees? Then what? And so that's what we're going to try to understand more in our continuing research.
Fantastic. Thanks, Bob. And thanks, Matt. Matt and Cliff, maybe the final word for you two, one of you two or both. How large are the effects that you found from your modeling so far in terms of financial costs or losses, or however you want to express that?
Matt, you want to take that on?
Yeah, sure. Yeah. I can kind of maybe share just one slide to finish. If I can just share my screen again very quickly. So this kind of gives you some idea of sort of the impact of some of these scenarios. So in this case, we took the SSP5 scenario at a 5 and 10 year horizon. And the blue histogram here shows for a fixed income portfolio what we think the market value of a portfolio would be at those horizons, given a starting value of $1 million. And the green shows the impact of the scenario from our model in terms of how that would stress that distribution. If we take the mean impact scenario, the effect at the 5 year horizon isn't very big. If we, however, take one of the more severe scenarios, and I think this is a 1 in 20 year scenario from the model, we see a much bigger impact on the distribution at 5 years and a very large impact in 10 years' time. So that gives you a sort of idea for a typical fixed income portfolio, what the sizes of the impacts might be from the model.
Terrific. Thank you, Matt. Definitely impacts that are big enough for a fixed income manager to be concerned, given the thin margins in that sector of the market. Matt Lightwood, Bob Bremer, Cliff Rossi, I have enjoyed this immensely and learned a lot, and I hope that those in the audience would agree. A recording of this video will be present on the second objective function tab at the Center for Financial Policy's website within about a week. I think we have to get it closed captioned first. I enjoyed this very much and look forward to seeing more from you three experts, and maybe we can schedule another call again when you've updated your paper or done more work. Thank you again.